All right, next we're going to look at what's called the fractional reserve banking system and how it relates to the Federal Reserve and the money supply. So our banking and money system is a fractional reserve banking system. And it's basically this system where commercial banks like SunTrust and Bank of America hold reserves, which is cash on hand in the vault, that is less than what they have in recorded deposits. Okay, so what that means is that when you go and deposit, say, $100 in the bank, they actually don't keep all of that money on hand. They only keep a fraction of it. Okay, thus fractional reserve banking. And this type of banking originated when goldsmiths in Greece issued notes that exceeded the value of gold and silver on hand. So this is where fractional reserve banking began. Was in Greece. So again, what are reserves? This is basically deposits held by these Federal Reserve District banks for depository institutions. So the bank's excess cash that they keep with the Fed, right, the Bank of Banks, plus any cash they have in their own vaults. Okay, so that's what reserves are. It's cash on hand, whether it's in their own vault or stored with the Fed at one of the district banks. And so the amount of money they have in the vault, the amount of cash they have in the vault, will depend on something called the reserve ratio. And this is basically the fraction of transaction deposits that banks hold as cash, as reserves. And the size is determined by a couple of things. Firstly, by what's called required reserves. So the required reserves are reserves or cash that needs to be kept in the vault that the Fed tells them they have to have. Okay, so this is a requirement, a regulation that's imposed on commercial banks by the Fed. They say you have to hold at least this much amount of money, this fraction of money in reserves. And then the bank can optionally, voluntarily hold excess cash or excess reserves. And if you add these two together and divide by the amount of checkable deposits on record, then you get the reserve ratio. And we'll look at that more in a second, but let's go back quickly to this discussion of assets and liabilities. So as I mentioned when we talked about that, I mentioned something called the balance sheet. So a bank's balance sheet is a statement of its assets, what it owns, and its liabilities, what it owes. And it's called a balance sheet because these things have to be in balance, right? They have to equal each other. So what it owns has to equal what it owes. So thinking about this balance sheet, let's think of how a single depository institution would react to an increase of a deposit of, say, $1 million. So suppose you had $1 million in cash, or you had $1 million check, and you took it to the bank to deposit it. What would happen? So in order to think about this, we're going to examine the balance sheet of a single depository institution called typical bank. And we're going to make some assumptions in this thought exercise. We're going to assume that the reserve ratio is 10%, meaning that whatever someone deposits, the bank has to keep 10% of that in cash on hand or on deposit with the Fed. For now, we're going to assume that there are no excess reserves, so the bank only holds on reserve what is required by them, by the Fed. They don't keep any extra. We're also going to assume some things for simplicity. We're going to assume that transaction deposits are the bank's only liability and that loans are the bank's only asset. So every time a loan is made, the other thing we're going to assume here is that every time a loan is made, the proceeds are put into a deposit account. So when someone borrows money, they just put it into a deposit account, like a checking account. All right, so what happens with that $1 million that is deposited? Well, when it's deposited, it becomes a liability to the bank, right? The bank owes that back to you because you deposited your $1 million with them in the bank. So they owe it back to you, so it's a liability to them. And then because this is a balance sheet, that $1 million liability has to be balanced out by $1 million in assets. Now recall that the bank only has to keep 10% of it as cash in the vault or with the Fed. So that's the reserves, right? So 10% of $1 million is $100,000. So they keep that as a reserve. What do they do with the rest of it? They loan it, right? So they take that other $900,000 and they loan it to a business, or they loan it to an individual, or they loan it to a government. And both of these things are assets, right? So the cash in the vault is an asset. The bank owns it. Of course, they owe it to you if you want it back. And then they also own the loan, right? They own the money that is to legally be returned to them in the future. And those total $1 million as well. So as you can see, the assets equal the liabilities, and so we have a balance, right? The balance sheet. So that's how banks operate. That's what happens in real life. So what that means, I'll take a minute to pause here for a second and tell you a little bit more about what that means. It means that if every single person that banked with Bank of America went to the bank and tried to get their money all at once, Bank of America wouldn't have enough money to give it back, right? They can only operate because they rely on the fact that people don't try to withdraw their money all at once. They withdraw small amounts here and there, right? And in that way they can operate. But if everyone went to the bank all at once and tried to get their money out, the banks wouldn't have it. Kind of scary, right? Another scary aspect kind of our money system. All right, so how does the Open Market Committee play into this, right? With open market operations. So what does that mean? What is the Fed doing when they engage in open market operations? Well, they're either purchasing or selling existing U.S. government securities, bonds is one example, in an open private market, and the Fed is doing this, right? So that's called open market operations. Well, why are they buying and selling bonds? What's the point of that? And by the way, bonds are just a way for the government to borrow money, right? So if you wanted to lend money to the U.S. government, you would buy a bond, right? And then they would have to pay you the money back at some point in the future. That's what a bond is. All right, so why is the Fed doing this? Well, it's doing that to manipulate the money supply, right? So what is the effect on the money supply if the Fed engages in an open market purchase by buying a $100,000 U.S. government security from a bond dealer? Well, when it does that, it effectively increases the money supply, right? It takes cash that it has in its vault, that it got from the Treasury or whatever, or printed, and it buys a security, right? So it takes a bond out of the market and inputs cash into the system, right? So by buying bonds, the Fed increases the amount of money that's in our system. Now, when it does that, that money, we're going to assume, becomes a deposit, right? So suppose I sold them the bond. I sold the Fed the bond. They gave me $100,000 cash. I'm going to take that cash and deposit it. Well, of course, the same thing happens when you deposited your $1 million check, right? I deposit it. It becomes a liability for the bank. They keep 10% of it, and they take the other 90% and loan it out. Okay. Now let's take this a step further. What happens after they loan it out, right? So bank one keeps 10% as reserves. They loan out the other 90%. The borrower who receives the $90,000 from the loan then takes that $90,000 and they themselves deposit it at another bank. Okay, so they take their $90,000 that they borrowed, they deposit it at a different bank, or maybe the same bank, it doesn't really matter. And then the same thing happens. It becomes a liability for the bank that they deposit it with. They keep 10% of it as reserves, and they take the other 90% and loan it out. And the process continues. So why are we going through this exercise? We're trying to see what the effect of a $100,000 bond purchase by the Fed does to the money supply. So the original purchase is $100,000. So that's $100,000 cash put into the system. But as a result of our fractional reserve banking system, it ends up generating an additional $900,000 in money. So the Fed injects $100,000 and it increases the money supply by $1 million. That's how fractional reserve banking works. Okay, so the process of depositing money and the bank loaning a fraction of that money out creates more money. If your mind is melting right now, I don't blame you. But that's how our system works, right? So here's how it all works out, right? So this process continues, right? So here's the initial deposit, reserves, loan. That loaned money is deposited. Some reserves from that. Fraction is loaned. Continues on and on and on. And the total amount of money that is created from that initial $100,000 is $1 million because of the reserve ratio of 10%. Okay, and so this is kind of the stages of the expansion of the money supply, right? So let's see, the $100,000 is here. This darker green represents the money that's loaned. That is deposited. Then there's a new loan as a result of that, which is deposited. That creates more money that can be loaned. That's deposited, etc., right? And so we can come up with something called the money multiplier to figure out exactly how much the initial injection of cash from the Fed will expand the money supply. That's what the money multiplier tells us. So in this case, it's 10. $100,000 times 10 equals $1 million in total new money. And really that's the potential money multiplier, because that's sort of the maximum that it could increase, because in reality not all of the borrowed money gets deposited, right? Some of it might not get deposited. So what we're really talking about is the potential money multiplier. What's the most that the $100,000 could increase the money supply by? And the way to calculate it is it's 1 divided by the required reserve ratio, which was 10% or 0.1. So 1 divided by 0.1 is 10. Okay, so there's the equation for it. Then there's also something called the actual money multiplier, which is just basically, you could reverse engineer this equation, divide the actual change in the money supply, divide it by the change in total reserves, and that would give you the actual money multiplier. So it's going to be less than this, because this is the maximum that it could increase by. It will be less in reality. All right, so this is basically the exact example we just went through, right? The Fed buys $100,000 of government securities, and the required reserve ratio is 10%, which means that the potential change, the maximum change in the money supply will be $100,000 times the potential money multiplier, which is 1 over the required reserve ratio, and that gives us, this comes out to be 10. $100,000 times 10 is $1 million. And like I said, the actual money multiplier is going to be smaller than the potential money multiplier, and this is because there is cash leakage. So when borrowers want to hold some of their loan as currency outside of banks, right? So maybe a borrower holds some of the borrowed money in a safe in their house, in which case it's not going to help increase the money supply. So the actual money multiplier will end up being less than the potential. As far as money multipliers in the real world, it turns out that the M1 multiplier is somewhere in the range of 1 to 3. And the M2 multiplier was around 6.5 in the 60s. It increased to over 12 in the mid 2000s. And since the Great Recession, it's been around 4. And that's despite the fact that the actual, or sorry, it's the potential money multiplier right now is 10 because the required reserves ratio is 10%.